Hello everyone, welcome back to yet another tutorial on the DCF valuation method. So in this tutorial, I'm going to show you how you can value a stock, a company using the discounted cash flow valuation method. So without wasting time, let's dive right into it. So the DCF method is one of the tools that is used by investors and financial analysts to value a publicly traded company. So the objective is to understand how much the company is worth, or how much a stock is worth. So they call it the intrinsic value. Now, so when using the discounted cash flow method to value a stock, you need to bear in mind that what we are doing here is we are actually discounting future cash flows into present day terms, so that we know how much the stock is worth today. Now, so here is we start with the assumptions. Here I've got my discount rate, which is the cost of capital, and the cost of capital here, it's because we are using WACC. So here the discount rate represents WACC, which is the weighted average cost of capital. In other words, the weighted average cost of capital is a weight between debt and equity, which is used by a company to finance its assets. Now we have got the perpetual growth rate, which is the infinity growth rate that we think our company will continue to grow in future. And we've got the current share price. So the current share price, this is the price that you can find in price sheets. For example, if you look at the trading updates, then you can find the current share price. Now we've got the number of common shares outstanding, and we've got the cash and cash equivalents. We've got the total debt for 2022, and this is a 5-year DCF, right? And we have got revenues there, and you can actually see we've got the EBIT margin at different rates there, and we've got the EBIT. Now the formula for computing the unlevered free cash flow starts at EBIT. So we have got EBIT there, which is earnings before interest and tax, and then we net out taxes, and then we get net operating profit after tax, and then we add back depreciation and amortization expense, and then we get to EBITDA, and we less working capital changes, and we also less capex, which is capital expenditure. Now we get unlevered free cash flows. So as you can see, so what I would do right now is I'm going to let me just delete that so that we compute together. So let me delete that and that as well. Now, so here we are saying EBIT minus taxes, and then we copy the formula to the right, and then we add depreciation, and then we apply the formula to the right, and then here we say EBITDA minus changes in net working capital items minus the capex, and then we apply or copy the formula to the right. Now we have got our unlevered free cash flow. So unlevered free cash flow, these are cash flows which are available to all the providers of capital of the company, right? So these are free cash flows that are available to equity holders, to lenders, and any other capital providers of the firm. Now, so here we are saying this is the cash flow before we even pay lenders and other capital providers. So here we have got our unlevered free cash flow for 5 years. So now we want to compute the terminal value, which is the value of the company in perpetuity, or in the infinite value of the company. So we will start by using the free cash flow in year 5. So here we come back here, and then we multiply that we multiply by the growth rate, which is the perpetual growth rate, and then we close bracket, and then we divide by the discount rate minus the perpetual growth rate, like that, and then we press enter on our keyboard, and then here we link that figure here, and then it comes there under the exit. So let me just adjust that. Perfect. Now we want to compute the present value, so I've tried to make this as simple as possible, because understand here I just wanted to use the formulas that you are already aware of. So I'm not going to use any fancy formulas or Excel formulas here. I'm just going to use some basic ones that you can find in your textbooks. Now when you are trying to discount something, or an asset, or free cash flows, what you need to do is you divide the free cash flow that you want to discount, you divide it by the discount rate, and then you mention to the power, the year that you want to discount that. So here what we are going to do is we take the free cash flow to the firm for 2023, we divide it by 1 plus the discount rate, which in our case is 8%, and then we mention to the power, which is 1 here, and then we press enter. And right, so before I copy that, you can see I have to anchor this, because we are using this fixed rate, the discount rate, right? So here I'll press enter, and then I'll copy to the right to the year 5, which is 2027. Now we have to discount the terminal value using the year 5. So we say 1 plus the discount rate to the power 5, just like that. Now we have got the present value of the unlevered free cash flows. Now, so I use a basic and simple discounting formula here. I would have used the NPV formula or XNPV, but I chose to use the simple formula here so that you can understand. Now we want to compute the intrinsic value. Remember that all these cash flows are referred to as if we add them, they are referred to as the enterprise value. This is the value of the entire firm, which is the value that is attributable to both equity and lenders or capital providers. Now to do that, we only have to sum these cash flows here, and then you press enter, and so we have got the cash balance for 2022, which we are going to link here. We also have got the total debt, right? So now we want to reverse engineer from enterprise value to equity value. Mind you, to get to enterprise value, we can say equity value, we add total debt, we less cash. So that is an equity value plus net debt. So here we are doing the sum. So net debt is just total debt minus cash. Now to reverse engineer from enterprise value, what we are going to do is we are going to add back cash, and then we less debt, right? So that we get to the value of equity holders, which is the equity value, right? So basically now we've got we can now see how much the company is worth. So this is the value attributable to just equity holders, so which is 196,018.9 cents. Now we need to divide that to get the intrinsic value per share, or the equity value per share, or the intrinsic value, just that. So we take that figure here, and then we divide it by the number of outstanding the number of common shares outstanding, and then we get an intrinsic value of $3.60. So now you can see our current share price here. Our current share price is $5, and then the intrinsic value is $3. So this is how much the company is worth, right? The stock is worth. So we can see that in the market right now, the stock is overvalued, because we got the figure which is 3.6 here. So it means the company is overvalued. It doesn't make sense to buy this stock, but it does make sense to sell it if you were holding this stock. That's what it means. But in the event that, let's say, the current share price was let's say 3.6, and then the equity value per share was $5, then it means that it would mean that the common stock is undervalued. So it would make sense to invest in the common stock, because we anticipate that in the future the stock would appreciate in value, right? So basically that's how you can value a company using the DCF. Mind you, this is just an example, and this is I've tried to make this as simple as possible, so that you can understand the mechanics of the DCF valuation method. If you have found this video useful, then I ask you to subscribe to our YouTube channel, and don't forget to like and comment and share it with your peers. Thank you so much for watching. God bless you.